Hello, everyone. My name is Christian, and this is actually, I believe, our fifth Z Investor Sit Down. Today, I'm here with Kris from Growth to Value. And for those that don't know, Kris is a long-term investor focused on holding quality businesses that he believes can give multi-bag returns. So in this case, we're talking 5x, 10x over the course of a really long time. He's also Seeking Alpha author for potential multi-baggers. And of course, all those links will be in the bottom or the description of this video. But I'm sure that intro probably didn't tell us all we should know about you. So if you wanted to add a little bit more to that, or even tell us a bit more about your personal investing journey, yeah, that'll be great.
Well, my investing journey actually started quite late, so I'm a bit jealous of you in that respect. I never really was interested in investing. I mean, I didn't see it at home, etc. It was only in 2013 when my wife was pregnant that I started to get some sort of primal feeling of having to gather for the unborn child. And, that's how I stumbled upon stocks. After a while, I first looked at collectible whiskeys and art and other things. And then if I have loved one thing, since I was a child, it has been studying, not particularly at school, although I did quite well there, but I have always been very curious and I always want to know everything about everything. Yeah. And so stocks is a great subject, and because you can know a lot about everything by just studying stocks, and especially about the future. I have always been a very optimistic and forward-looking person, and if investing is about the future. Not about the past, and that's something that really attracted me to investing. I started reading, I started listening to podcasts, reading articles, reading books, etc. Literally thousands. I mean, not the books that were maybe I don't know, somewhere between 50 and 75 or so, but articles really thousands, and podcasts as well. I read a lot of articles about on Seeking Alpha, and I started making comments there, which you can always do, and I learned a lot by those comments, and started doing that more and more, and at a certain moment somebody said, your comments are definitely or often more interesting than the article itself, and almost as long. Would you start writing? And I thought, well, yeah, maybe I should. Also, because if you write, you make yourself accountable, and you see, what you invest in, and that's something I always think is a good idea. You don't have to write articles, but just for yourself, write down in maybe 10 points or so, 10 bullet points, why you invest in a company. And if if the stock price drops, you look at at the time when you bought, and you think, well, is this still true or not? Because a lot of people just look at the stock price, because it's one of the few things they know about a company. And of course, if you're a trader, that's okay. But if you're a long-term investor, you have to be able to stomach those 50% drops. You'll definitely have in your portfolio. And it's like Charlie Munger said, if you can't stand a 50% drop, just put it in an index fund. And even then, in 2008 and 2009, it was more than 50%. So that's where, in 2016, I started writing for Seeking Alpha. And then in early 2020, I launched Potential Multibaggers, my marketplace on Seeking Alpha. And, I started doing this full time. Recently, I also launched a second marketplace together with InvestQuotes, who you can also find on Twitter, Leandro, Best Anchor Stocks. Because I have actually 4 buckets of stocks, potential multibaggers, which should have the potential, and that's why that first word is very important as well, the potential to go 10x or more in the next 10 years. Now, of course, inherently, I will always have losers there. It's impossible to, even the best investors like Buffett and Lynch and what have you, they had hit rates of 55, 60%. Some great investors only had 35%. And a lot of people focus on the losers there, but I think it's very important to focus on the winners as well, because there is, in theory, limitless upside, but very limited downside. So you can only lose 100% unless you're leveraged, and that's something else, which I never do. I never go on margin. I never leverage. I never, I just invest for the long term.
Yeah.
And because if it always sounds attractive, when the market, especially when the market goes up, and that was in 2020 after the March crash, COVID related, and then in 2021 partly as well. A lot of people went on margin because the stocks can only go up. Well, not really. So again, if you're a trader, yeah, I could see a point if you said quite strict stop losses, but as a long-term investor, I mean, it's always in those periods when stocks drop. They always drop a lot faster than they go up, and it's then that margin can be really dangerous. So potential multi-baggers should have the possibility to go 10x, but at the entrance ticket that you have to pay is volatility, of course. So for example, Shopify was the first potential multi-bagger. It was a 20 bagger just a few months ago. It's a 12 bagger now, or something like that. I should check it, but it's something like that. I think 11 or 12 bagger. So that's how fast it can go, and you should be comfortable with that. You need volatility. People always look in a negative way at volatility because they always think about the downside of volatility. Stocks drop very fast, and that's true. But you also need volatility for stocks to rip, over quite a short period of time. They can double, and you'll hear a lot of investors say that, they have gone up too fast. What goes up must come down. But of course, there will be a certain moment where Shopify has come down right now, for example. But I have heard that for a very long time, and stocks can go up 20x as with Shopify before they come down again. So that is potential multi-baggers. Then I have budding anchors, which are a bit more, established companies already, and they should go up they have the potential to go up 5x to 10x, but they still have that high volatility. And then you have early birds, and the name already says there, I think, very early companies, which should take up a very small percentage of your portfolio. The early bets, which may have the potential to go up maybe, I don't know, 25x or 50x or what have you.
Yeah.
But maybe completely not, because it's still so early that the outcome is more difficult to. It's always difficult to predict, of course, but even more with those smaller companies. And then I have always had anchor stocks, and anchor stocks are the Facebooks and Amazons and Apples and what have you. Adobe and Salesforce, etc. But I have never really written about those. I didn't have the time, to be quite honest. And also I always have thought, there's enough about those big companies out there. But then a lot of my subscribers are, really wanted to have my kind of analysis apply to those big companies as well. So that's why I started Bast Anchor Stocks together with Leandro Invest Quotes, which and he does most of the work. He does most of the analysis and research, etc. Of course, we don't pick Amazon, and we just say, FANG is good. I mean, not
Yeah.
FAM, not Netflix, but Amazon and Apple and Microsoft, of course, they are great anchor stocks. But we also choose the ones which are still a bit smaller and could have the same runway over the next 10 years. So very stable companies, lower volatility, but still a lot of upside. They're probably going to beat the index considerably without going 10x over the next 10 years, of course. So that's a bit my journey.
Yeah. And I guess going back to when you started investing, you mentioned it was like kind of later into your life. So like how old were you when that happened?
I think I was 35, 36, something like that.
Yeah. And there's probably a lot of people who are in their 30s, maybe even 40s. And I guess like it kind of speaks like it's not too late even then, right?
No, definitely not, because still now I'm 45 now, so 9 years ago, about 36, yeah. So even then, I mean, for a lot of people, I think retiring early could be a goal of investing. If you're 36 like I was, and you add 25 years, for example, or 20 years, that's still a very, very long time. And if you look at a lot of the best stocks out there, what they have done over the last 20 years, it's incredible. It's insane. I mean, just look back, Amazon 20 years, it's or Apple, or a lot of others, Salesforce, or there are lots of, or Adobe, or what have you. And even you only need one or two of those to have really outsized gains. If you have one Amazon and it's up, I'm just making something up, but 145,000%. Well, I think you'll beat the market. So no matter how many losers you have, and that's actually the real fundamental thesis under potential multibaggers. So yeah, inherently there will be more losers. Although I'm still quite okay. I think I'm about 50% winners versus losers, even now at this low point for high growth stocks. I'm the portfolio still considerably beats the market. Even now, with I think it's something like 50-ish% on average per stock. So that's still considerable. And it used to be a lot more. It used to be 200 etc%, and that's exactly what I expected out. I wrote an article before I started this series, and that's how I said those kind of stocks would behave. And you'll see the same thing once high growth is in vogue again. And we don't know how long it will take, but if they will rip, and they will go 2x, 3x, 4x in a very short amount of time, a year, 2 year, and a lot of value investors won't understand. But it's with high growth stocks, you see that the next 4 or 5 years is already in the stock price, and a lot of them have very consistent high growth, and that's the secret. If you have like Amazon has had a consistent high revenue growth, and even if the multiple comes down, it doesn't matter that much. You can have the multiple cut in half, or even minus 75%. If the revenue growth keeps compounding at 30-35%, maybe even more, you'll still have very good results at the end, and especially if the longer your holding period. So there have been some studies about long-term results in the stock market. And you see that over the short term, the most 1 year, the most important factor is the multiple. So if you I almost said invest, but for me, investing is really long term. So if you have a stock for 1 year, the multiple is the most important thing. It accounts for, I don't remember exactly, but somewhere in the 40s, mid 40%. Now, if you look over a 10-year period, the multiple almost doesn't count. It's depending on the study, 1% to 5% of the total return, while revenue growth is by far the most important factor there. So long-term revenue growth is what I look for. And of course, revenue growth can come down fast. Just look at a stock like Peloton, for example.
Yeah.
It has really changed a lot in just the last 12 months. So it can go fast as well. But again, those losers will always be inherent to investing in general. So no matter which style you have. So I always find it very, childish to say to somebody else, oh, look at that stock of yours, that pick of yours. I mean, everybody has losers, and it just shows that you don't know investing if you say such a thing about someone else.
Yeah, and I really love that idea that like the stock price is disconnected from the actual business, because when you take a look in 1 year, even like up to 3 years, right, the stock price can just trade on sentiment, right? It can do whatever it want at some point, and so it's really, really crucial that you're making sure that the business is improving, and then you're setting yourself up for a place you want to be in like 5 years or whatever.
Yeah, indeed, and that 3-year point, that's the tipping point. So after 3 years, revenue growth starts to take over from multiple. So that's why I always say you should invest at least for 3 years, preferably longer, 5 years, as you say, or 10 years, or 15 or 20 years. And that's also why it's so good to invest for from a very young age. So we invest for our child since she was 2 years old. I had to convince my wife for 2 years. That's great, because she will not need the money until probably when she buys a house or gets married, or wants to make a trip around the world, or I don't know. But it's a very long time. So, and that's ideal. And, you're in a great position there as well. I mean, you have time on your side, and time is the most important factor in investing. It's much more, everybody's talking about timing, but time is so much more important. And if you look at, research, if you just invest, and this is about the indexes, but if you invest at the lowest point each year for 20 years in a row, I mean, then you're the perfect market timer. Or you just invest whenever you get the money each month, for example. The difference is not that much. It's really not that much. And that's still where people concentrate on. The most important thing is investing. And that makes a huge difference between, bonds or saving, let alone savings accounts. And so, and that is the most important distinction. And all the rest is, fun to talk about, but quite, irrelevant in the bigger scheme of things.
Mm-hmm. And I guess I was going to ask you, like, why specifically you got interested in growth stocks in general, but I believe you've already answered that question.
It's really those, that I think a portfolio should reflect who you are, and it's my personality to be optimistic, to be very interested in what is coming, how the world can get better, and that's why I invest in growth stocks. But some people are more conservative. Well, that's great. I mean, why not take some value stocks or dividend stocks? Or it's so, I mean, so horrible that so many people try to convince the rest of the world my kind of investing, my style is the only one there is. It's the only good one. No, it should be good for you. And there have been identified 300 ways of investing that have consistent alpha if you apply them consistently, which is a big problem for a lot of people. But so why would you want to say, my kind of investing is the best kind? I mean, and I have a lot of subscribers who only have growth stocks for a part of their portfolio because they say, well, I'm very interested in, but in my situation and who I am, it's better for me not, just to have 20% or so. That's great. And on the other hand, I have, people well in their 80s who say, I want to have growth stocks. I'm sure I will live another 10 years or so no problem for me. I have enough money in houses or what have you, so I just want to maximize my returns in the next 5 to 10 years. Wow. I mean, how flexible, how optimistic can you be? Those kind of people are really interesting. And I mean, an example for me, I want to be like that when I'm 80.
I guess, and also, like, I'm sure there's been like so many new investors coming to the stock market in like 2020, 2021, especially. Like even myself, I was like very interested in like late 2020, and then, I've only been in the stock market for like a year, so very, very short time. But to all those beginners, I guess, who are like very I guess a lot of people would be drawn to these like really high returns, right? What advice do you have for like people to get started specifically with growth stocks, because they can be risky? So are there any like principles that you follow when usually making your decisions or whatnot?
Well, first I want to talk about the word that you used, risky. There's a difference between risk and volatility for me. I know that traditionally they are made equal. Why? Because a lot of those quants want to quantify everything in life and in investing, which is impossible. I hope you will never quantify your partner, I always say. I mean, how are you going to do that? I hope you don't score him or her for everything, right? And the same thing goes to investing. You cannot know everything from the numbers. I mean, how are you going to quantify, a fantastic CEO, for example, a visionary CEO? You cannot quantify that. How are you going to quantify new opportunities, optionality, etc., etc.? So there's a lot of things that you cannot quantify. Now, risk for me is how big the risk is that you permanently lose your money. So that's a bit different than volatility, in which it means that stocks go up and down more, right? So that's the first thing. I forgot the rest of your question. What was it again? Oh, the new investors, right? Go in slowly. I mean, I always dollar cost average. So that means that I invest the same amount of money every 2 weeks. And
absolutely.
For you, that can be every month, or every 3 months, every quarter or so, or twice a year. It doesn't matter. Every month, every week, for example, is another. But the same amount. Only when the stock market or a substantial part of the stock market drops a lot, like now with high growth, I invest a bit more, and that's it. So for the rest, I'm not going, and it's not even double or so. But for the rest, I change nothing. I invest the same amount each time. Now, if you have a stock which you're very interested in, and that stock trades at $100, and you invest $200 every month, you can buy 2 shares when it trades at 100. Assume that it drops 50%, not just because of that stock, but because of the whole market, or because of high growth like now. With $50 you can buy 4 shares, and in that way you'll bring your cost basis down quite a bit faster, especially if you spread over time. Now, if you look at theory again, lump sum investing is better. So putting it in all at the same time, but that's theory. I mean, that's people have been killed by rivers of statistically when you're deep, right?
Yeah.
So if you put in everything at the same time and then the stock market crashes, well, you don't have anything left,
Yeah.
right? Or not that much to take advantage of. So that's one very important thing. Go in slowly. Secondly, don't get too overconfident in a certain stock position, what have you. Scale in slowly, and slowly for me means usually more than a year, because that's or even 2 years or 3 years. That's almost always what you need to see the full story playing out. I have made an exception with C Limited, and I had quite a full position there already after 3 months or so. But that was really an exception. Another one is limit your cost basis, which means that normally I will never take a position of higher than 8% of my initial cost. Not, if the stock drops 50%, you could say, I'm going to add again. No. I look at my initial cost. What have I invested initially? And if that is, above 8%, well, again, I have made one exception. My highest conviction stock, C Limited, is about 10%, but that's really an exception. And most positions are 6% or under. All of the rest of my positions are 6% or under that, and most of them are about 2 or 3%. So diversification, because if you have enough stocks in your portfolio and one goes out, your Peloton, for example, it's not out, not at all, but it's down a lot. Now, if you have 25 positions or so, it won't hurt you that much. Of course, like now there's a general high growth slump. That's okay. I mean, I have lived through periods like that before, and it's a quite severe one right now. But if you look at the fundamentals, you see that those companies are still doing great. Were they overvalued? Probably, but that's you see a lot of people coming out. I told you they were overvalued. Well, you have been saying that since 2017 when I bought Shopify, right? So it was at 77 then. So this is how it goes, and the best high growth stocks will be called overvalued for a very, very, very long time. It's only since 3 years or so that Amazon, that the voices about Amazon being ridiculously overvalued are gone. Before that, it was probably 15 years or so. Netflix, the same thing. Tesla is going away right now. I mean, it's I don't hear the extremely overvalued voices that loud anymore. They're still there, but they're not front stage anymore. Probably some people will in the comments react to this statement, but you know what I mean, and that's often how it goes. So I don't care people saying stocks were over, and of course some were overvalued, but you cannot time the market. They can be overvalued for years and years and years in a row, and still have great returns. And if you invest for the long term, you will have those overvalued stocks, and you will have those times when the stock goes down 40, 50, 60%. If you have the time, if you are interested in long-term investing, one of the best books to read is 100baggers by Kris.
I think I've heard of that one. Yeah.
Yeah, and he shows 365 stocks that have gone up 100 times, and he excludes biotech and those almost flukes, right? But stocks like Amazon, like Monster Beverage, like 365. So I won't name them all. But what you see is that every single one, all 365, have been down by 50% at least once. Most several times, most a lot more than 50%. So, that should make you think that, if you still see, so I'm a Peloton shareholder. I mean, I'm not afraid to say that, although it's not fancy to say that anymore. And I have not sold. I have not added to my position that much. Not at all, because I don't want, original allocation was 3.5% or so. So I'm not going to add, because my conviction right now is not higher than that 3.5%. But I'm still holding. I still see a valuable brand. I still see a lot of potential for the long term. And of course, they have really screwed up over the last 12 months or so. And and it could still go down. But I think at this moment, it could, there's more upside than downside. So it's very important to see, if you invest for long term, it's important to see the long term. And of course, if you have started out recently and you're down a lot now because you have growth stocks in your portfolio, it feels really bad. And I have had the same thing. When I really started in growth stocks, that was 2017. I started with growth stocks, and then 2018, the fourth quarter was, they call it the SaaS apocalypse. All the SaaS stocks, software as a service, were down a lot, like 50-60% as well. If you have just invested your money in those stocks at a higher price, you think, oh no, oh my gosh, I'm down so much. If you just hold and you look at the company very critically and you see that it's still, the same company, you'll hear lots and lots of negative noise out there at that moment. Well, noise is usually negative, but so it's hard if you don't know the business very well, to stick to the plan. And that's also how I see my function at Potential Multibaggers. I'm the one who provides the information necessary to hold if a company still does well, but the stock is down considerably.
Yeah. And I really like that idea as well, actually, because these drops in whatever growth or individual stocks are going to be inevitable. And it all comes back to that idea, because, for every stock, there's a business behind it. And I believe Peter Lynch mentioned that, stocks are going to be following earnings, right? It's not a lottery ticket. So in that case, if you have an understanding of all your businesses in your portfolio, then a drop should actually, get you excited, because, it brings more opportunity.
Yeah, I mean, it's always hard to initially when stocks drop a lot. I mean, even at this moment, I still think, oh, this. It never feels great, right?
No.
It's only when they have been down for a while that I'm getting more excited then. And when they go up, especially when they go up in March 2020, I thought, well, initially the same thing. Oh my God, this is it always feels a bit like the end of an era, which it never really is. And then in April already, especially May, stocks started to go up, and I was no, please stay depressed.
More discounts, yeah.
So yeah, more discounts, but that's also peak bearishness. I remember that I wrote a public article down on Seeking Alpha about Square, and Square was down something like 67% or so. And I wrote, I keep adding to my position, something like that. That was entitled, why I keep adding to my Square position. The bearish comments on that article were really, really funny. I was the piper leading the lemmings over the ridge, and it's going to single digits, you idiot, and it's and then it ripped, of course. So that's something you should be ignoring, completely ignoring. I mean, it's always a bearish fest when a certain category of stocks goes down, and it's a long-term bullish signal. The more you see that, over the long term, it's probably quite a good time to add.
And I guess I've learned over even the short period of time, for 1 year that I've been involved, right? There's always going to be people who are going to be disagreeing with you. And it's pretty crazy how things, how fast things can change, right? Especially, if you took a look at some time period in September or even August of last year, right? You'd see everybody's super greedy. And then coming into December and January, it completely flips.
Yep. And that also has to do with, we have had a pandemic, which, we have never had before. And there will always be situations like that, which have never happened before. The great financial crisis in 2008 and 2009 was really scary as well.
Yeah.
I mean, the whole financial system was, on the brink of collapsing. And there will always be times like that. And I think it's, what we have seen now is value stocks have really crashed in 2020 and have not recovered until the end of 2021. And at this moment, you see the complete reversal, because growth stocks were up so much in 2021.
Yeah.
And now they're down the drain, and that's always the ebb and flow of the market, and that will always continue, and the market always exaggerates it both ways.
Yeah, absolutely.
And as a really long-term investor, you can stand back a bit and say, oh, interesting.
Yeah.
Interesting.
And I guess this is a bit off course, I guess. But something else I wanted to ask, experienced investors, I guess, what are your worst mistakes? Does anything come to mind? And did that help you, I guess? Did you learn any lessons from those?
My worst mistakes, I have made quite a bit of really bad stock picks. I picked some Chinese companies in 2017, 2018, and they looked quite attractive. If you looked at at their valuations, at their growth potential, etc. I have learned that the Chinese government is not the same as the American government, right? And I already knew that, but I thought this risk has already been calculated into the stock price. Nope. So it's always a question: what have you learned from your losers? I have learned that even more than I already knew at the start, that management is the most important thing there is. It's the people who build the company, and it's I have 15 criteria that I use for my potential multibagger picks, and one of them is a visionary CEO, and I always use a quote from Steve Jobs, who says, there are lots of people who want to find a way, and I'm just paraphrasing because I don't know it by heart, and they are all looking at these stupid little maps. And then you have someone standing on a tall building, seeing the road ahead, And that's a visionary CEO. And he talked about being smart. I think it was not about vision or so, but it was about being smart. But I think that he described himself there. So a visionary CEO, and they always have, really big visions, which can be made fun of quite easily. I mean, Cloudflare has been a potential multi-bagger pick since 39, and their mission statement is to make the internet better. Wow, you can ridicule that very easily, right?
Yeah.
Amazon at the time being the most customer-centric company in the world. I mean, those are, quite big, undertakings, right?
Yeah, absolutely.
And can be ridiculed very easily. But that's a common thing that most great companies have in common. And I'm reversing the question actually, because I'm you can a lot of people say, oh, what can you learn about the stocks in which you lost? Well, I think that you can often learn more about from your big winners than from your losers. Of course, you have to look at your losers as well, but they're just part of the game. You will always have them. And I think if you concentrate on winning, well, you will win, right? Because people, if you constantly look at avoiding losses, well, I mean, what are you concentrating on? On losing. And what you concentrate on is extremely important to reach your goal. So try to concentrate on winning and not on losing.
I guess the point you made earlier about the management aspect of a business, it almost seems like it doesn't really make sense, I guess, at first. It almost seems counterintuitive. Like, you'd think you'd want to like focus like specifically on the numbers and that kind of stuff. But in reality, I think like forward guidance for any company is like more important than people give it credit for.
Yeah, well, for forward guidance, but that's still numbers, right?
Yeah.
I mean, just if you look at, I remember why I picked Shopify, and I had already looked at it, and I thought it was, here it comes, ridiculously overvalued. And why did I pick it? I heard a podcast interview with Toby Lutke, the founder and CEO of Shopify, and I thought, man, this guy is a genius. This guy is so smart, and he has a vision, and he has a long-term plan, and he's interested in everything that that's going on in the world, and that can help Shopify. And that was the spark to buy my first shares of Shopify. I first bought it for my private account. I had not started potential multibaggers yet, because first it was a free series on Seeking Alpha, and people can still read those articles as well. They have evolved a lot over time, because I write 5 deep dive articles now, which only was 1 at a time. But I first bought after that interview, and it was what you shouldn't do. Now, what I mean is it was emotionally, but I think that a lot of people underestimate their emotional intelligence, and it's how shall I put it? It's almost a sin if you talk about the human aspect in investing, and it all has to be numbers and rational, etc. But I think people completely misuse or completely ignore a part of their brain, which is also very important. And of course, it's not just a story. It has to be that, and it's much harder to explain why a CEO is a visionary than, look at the forward guidance, for example, because you cannot quantify it. And it's a personal feeling. And, it's often seen as subjective, which it is for a part, but you also have something more than subjective, which still is not objective, but intersubjectivity, which means that quite a lot of people agree on the fact that Toby Lütke is a genius, or an extremely good CEO, or you can discuss about the exact terms, but there is some sort of consensus there, and that means something as well. That a lot of people who are interested in the stock market think the same thing, and that knowledge cannot be put into numbers. And I think for individual investors, that's very important information, because the quants will not use that, short-term traders will not use that. It's something that individual investors can use a lot. And if you look well, there are more of that kind of people. As I said, Cloudflare, Matthew Prince is fantastic CEO, and he has a long-term vision as well. And there are more people like that. People don't realize that, Matthew Prince, Toby Lütke, they in 10 years time, they could be the Jeff Bezos or Steve Jobs is maybe an exception, but of that era. So look for those kind of people. And again, your human intelligence is very important as well. Of course, if you have a story, and that's what I did with Shopify as well. I said it was emotional, but what I did before I bought was I looked at the numbers, and I looked, does it make any sense if I look at the future? Can I see this continue to grow at this high rate? And yes. Yes, the answer was yes. So the numbers should actually confirm what you see in, with your human intelligence. And that's important as well. So use both sides of your brain, not just one part, not just the story, but also much more common in investing, not just the numbers.
I feel like you're reading straight off my question list here, because the next thing I was going to ask you is specifically about emotions and whatnot. I guess especially now, I can imagine how different it might have been 10 years ago. But you have Twitter, social media, even the general traditional media. I guess there's so many different things being sensationalized. And oftentimes all of that, like you mentioned, is just noise, right? And so how would you, I guess, manage that in your own portfolio? Do you ever feel like sometimes, you've made decisions based off emotions and then ended up regretting it? Or do you have I guess how do you have a resolve when you're making your decisions?
I try to protect myself from my emotions by not selling, and that's already something very important. And I protect myself from buying impulsively by checking the story completely. As I said, I write 5 articles. Of course, I do that for my subscribers, but partly for myself as well. I want to be an informed investor. So I think both are very important. And I sometimes get the comments from people, oh, but you should have sold a long time ago. Well, okay, maybe I should, but I prefer to err on holding too long than selling too early. I made that mistake, quite a few times. I sold Square at the time at 24 when I had bought it at 16 and a half, 17, something like that. And I thought, wow, 40% gains, right? Woohoo. I think it would have been better if I just held, right?
Absolutely.
And I bought back, Square then at 75, and then it dropped, and I kept averaging down till 50, 55, 57, something like that. Viva Systems, I bought Viva Systems at the time. Oh man, I don't remember exactly, but a lot, less, and I never bought it back, right? So if I look at the mistakes that I have made by holding stocks too long, they're dwarfed by the mistakes that I made by selling too early. And I think that if you know that, it can be, it's the same with Peloton, right? I could have sold it. There were red flags. I have to be honest there. And but I always will err on holding too long. And even I'm holding now Peloton, and can it go down more? Of course, everything is possible in the stock market. And if it will, well, that's okay. That's part of the game, and I will always have losers, and everybody will always have losers. They're just part of the game. But the upside, if Peloton can turn around, because people now, of course, Peloton is dead, right? That's what they say. Well, if you look at the numbers there, check your emotions, right?
Yeah.
If you look at the numbers, you see that they still have their revenue is not great, and they have cut their guidance twice. But if you look at the subscriptions, they keep going up. If you look at what people say about Peloton, that's still, they're very like a cult still. I've seen the same thing with Chipotle at the time. There were food poisonings, and people said, "Oh, they're dead because they're the company who are supposed or that is supposed to have healthy food, and now they poison people, etc., etc." And I think that actually for the brand it was worse than we see with Peloton right now, and it also took probably 2 years or so before Chipotle came back a bit. So I think, and they needed a new CEO. So the new CEO in Peloton made me actually happy. But and I could be completely wrong. Again, I could be completely wrong. But it's a consumer-facing company. I look at what customers say, and customers haven't changed their mind because Peloton has some bad forecasts, financial trouble, let's call it. Again, I'm just holding. And if the company turns around, it could be a winner like Chipotle. It could be not, again. But investing is inherently I can't find a word. Help me out there.
Maybe like uncertain, I guess.
Uncertain, yeah, that was the word. I couldn't put my finger on it. So it's inherently uncertain, and I think people should just be okay with that. And again, if you look at Shopify going up at this time, 11 times or 12 times or so, or Peloton losing 75%. That's a big difference there, a huge difference. And I can have several Pelotons, even if they don't turn around, and still do great. And again, we come back to the same thing: focus on what works and not so much on what doesn't work, and also zoom out. Again, at Chipotle, the mistakes had been made as well. Lululemon is another one, which had the management problems there were not so great. And if you look at stock now, and so people always think there's only one possible future, but the future is not knowable until you're there, right?
Yeah.
So in general, I just try to give my frame of thinking here, and not, this is not a recommendation to buy a Peloton. It's just, I just want to say that when there is a huge consensus, and I'm not actually a bit reversing what I just said about a consensus about a certain CEO. So, but if there's a huge consensus, this company is crap, and if you look at the numbers and you see that Peloton's revenue will go down, or has come down a little bit now, 5% or so. But if you look at what they did in 2020 and even 2021, they can see, for a big part, they continued growing a lot. And of course, the comps are very, very difficult if you grow, I don't know, in Q4 2020, it was 180% or so. And then you go down at 5%. Well, okay, if you look at it from a longer term perspective, and they can, when, of course, the revenue growth has to come back, sure. And if it's not for years, okay, then it's a really bad investment.
Yeah.
But there's so much emotion there. Check the numbers both with positive emotions, but also with negative emotions, because usually people exaggerate.
Mm-hmm. And I guess like even with the stocks you're talking about, you mentioned that like in general, I guess it's inherently uncertain, right? Nobody can tell the future. And I would also argue with stocks like those, it's always going to be like your strategy always has to be inherently long term, I guess. Like if you take a look at all the winning strategies that are long term versus all the winning strategies that are short term, I'm willing to bet there's a lot more that are going to be successful over the long term. And it baffles me why so many people like that get into the stock market focus on the short term, right? When it's obvious that your time is much better spent focusing on, holding these companies for a lot longer rather than, playing off of some emotions in under a year, I guess.
Yeah, well, I'm sure the traders will not like this, but it's true. If you look at research, it's easier it's not easy, but it's easier to have big returns over the long term. Now, of course, certain traders can be successful, but they're a very, very small minority, about 3 to 5%, depending on the research. No, I can't say research because I can never find research there. But on the numbers that I read, even from trading sites, everybody thinks that every trader thinks he is or she is in that 3 to 5%. It's the same thing with, if you ask people, are you a better car driver than the average car driver? 96% says yes. Well, there's a problem there.
Yeah.
And it's a bit the same with trading. With long-term investment, there have been a few researches, but they have not been published. So we just have to take the word of the people who, who talked about it for that. But in Patrick O'Shaughnessy's podcast, Invest Like the Best, there was that was it Josh Brown? I'm not sure, but could have been him, who said that there had been an internal research by Fidelity, I think, to see who the people were who invested the best, and most of them have forgotten that they had stocks.
Yeah,
a huge majority didn't even remember that they had stocks. They had just kept those stocks that sometimes they had inherited them and they didn't know about the stock market, or they just had forgotten. They went on in a different phase of their life, etc., etc. I have read another study in the Netherlands where they try to find the 30 best individual investors. Again, it was an internal study, so it was not published. And those people say that they have read it. I'm just saying what they are saying, and that 26 of the 30 were in the same situation, had completely forgotten that they had stocks. Now, of course, the problem is that you can buy great stocks. The most difficult thing is not buying them. The most difficult thing is holding them. And that's also why I err on, holding too long versus selling too soon. Because there will always be times when, a stock or a company screws up, and the stock, Apple in 2000, before, the general stock market crash, went down, I think, 45% in a day because they missed their earnings.
Yeah, it's crazy to me.
Netflix went down 80% in 2011 when in 2 or 3 months time, when they announced the Quickster, spin off, which they then, didn't do, and etc. So a lot of companies have gone through some difficult times and made mistakes, like Peloton has now. Again, I'm coming back to Peloton. I mean, I'm just writing an article for my subscribers.
Yeah.
Maybe that's why it's on top of my mind.
Yeah.
But it has happened a lot of times before, and of course, there will be stocks that don't recover from those kind of blows. But there will also be stocks that do recover. And as I said in 100 baggers, every single 100 bagger has gone through huge decreases. I mean, even Berkshire Hathaway, I mean, could you have a more stable company, has had 3 times in their history that they were down by 50%, at least 3 times. So, I mean, you will always have it. And if you cannot stand that 50% drawdowns, I think you should just invest in the general stock market, which is a good thing for a lot of people. If you don't want to read up, or if you don't want to research, if you're not really particularly interested in individual companies, well, I mean, it's okay to just buy an index fund. I think it's a great solution for a majority of people. And just, mail in the money and invest it every whatever month or quarter or every year maybe. So I think for a lot of people that makes a lot of sense. And if there are people now watching who want to start investing, I think it's even a great way to start investing like that and gradually learn about individual stocks if you want that. And if not, just continue like that. And it's I think for a majority of people, that's the best way to invest. And a lot of people say, oh, but to invest in the stock market, you really have to put time in it.
Yeah.
Well, same thing again. If you don't put time in it, you just buy a simple index ETF. It's better not to look at it often because people are afraid of the volatility, and if the stock market is now 30 or 35%, they can get scared, and they don't think, oh, it will come back, it will return, because that's when the stock market is in the news, right? In the general news, it's never in the news when it's up 35% over the last year, but it is when it's down 15% over 2 months or so. So